Hi, my name is Marie Conser. I'm a real estate broker here in Portland, Oregon. And in this video, I would like to talk about what we have experienced, what I would call the pandemic-driven market. So without further ado, let's start looking at what the stats are today in, for last month in October. And you can see that the inventory is slightly climbing. And for review, the inventory of homes for sale expressed in months is a metric that we're using that basically tells us that if no new home comes on the market, this is on average how long it will take to sell all the homes currently listed for sale. So anything traditionally under 4 months, and I would say today under 3 months, would be considered a seller's market. Because it usually reflects very strong demand and not enough supply of homes to meet that demand. However, this has a lot of other elements to it, and we will be diving into what the market has been during the pandemic months. And the pandemic started towards the end of March, and you can see it's slowed down during April, May, when people were wondering what was going on. And as people started moving into their homes and their housing needs changed and shifted, we're seeing a very strong activity. So let's dive into the details, because this led to price appreciation, which and actually this is not September, it's October. So in the last month, the appreciation was about 8% year over year, October 2021 to October 2022. But to put things in perspective, during the 2021 pandemic year, the appreciation year over year, so from beginning to end of the year, was 15.8%, which is a record. And in 2020, that appreciation was 7.6%. Now, pre-pandemic, it was at 1.5%. So we're not back to pre-pandemic levels, but let's talk about what truly happened. So let's address first the supply piece of the equation. When we exited the 2008 financial crisis, or in the years, I should say, following the financial crisis, that following decade from 2010 to 2019, what happened is access to financing for buyers dried up. It became so low that a lot of builders exited the market altogether, and the ones remaining reduced their production to a minimum. So this is what is reflected in this column. This is nationwide data, but we are missing a lot of homes that have not been built following the 2008 financial crisis. In the meantime, let's address the demand side of the equation and forget this piece. What I'm interested in this little bump here, which is a little bit of a baby boom, a mini baby boom here, which happens to be the early 90s. So about 30 years ago, we had a mini baby boom. Well, what happens when you turn about 30, you finish your studies, you move out of college or your parents, and you establish your own household. So when we dive into local data, this is what happened with supply and demand. So housing units, the ones built between 2019 and 2021 were 28,500. And so that's a supply, and the demand, the number of households created. So people, again, moving out of their parents' house and creating their own household unit, were 53,200. So we do have a shortage, which created a very strong demand met by a very low supply. Because in the meantime, the existing homes were lived in by healthy people who, during the pandemic, did not want to leave their home to go into maybe a more community setting. So people who potentially would have moved out stayed in their home during the pandemic, keeping those homes off the supply market. Now, there would not be much happening if financing was not available. So let's take a peek at the interest rates, because they have reached historical lows during that time. But looking back way further, in the 80s, everybody has heard that in the 80s, interest rates were in the 15, 18%. It was very, very high indeed. To support the economy, the Fed has been supporting low interest rates, and the rates have been declining steadily since the 80s to break under the 10% rate in the late 80s, early 90s, and to continue to steadily decline to break under the 5% in the 2009, early 2010. So here we are looking at this trend. Well, if we zoom in the last 5 years, we are seeing again that steady decline. In 2018, there was an impulse to move the rates back up a little bit, and they briefly crossed over 5% again. But there was another support to keep them down, and they broke under 4% soon after that. Anyways, here is your pandemic here, the beginning of the pandemic. This is that bump here where people, the markets especially, were unsure about what that meant. It was a worldwide event, and the impact was unknown in its width and in its depth. So anyways, bottom line is, knowing that people had to stay home and to support the economy with all those unknowns, there was an additional push from the Fed to support a low interest rate, and the rates went down, breaking under 3%, which was a historic matter. And in 2022, when we started the year, there was an expectation that the rates would go up. No prediction, no expert predicted that they would go up that quickly and that high. But that will be the topic of another video, what might happen next year. In any case, so what happens when you have low supply, strong demand? Oh, low supply, yes, strong demand with a shifting need for housing and low interest rates. Well, this is the beginning of the pandemic right here, where the sold homes outpace the homes that were listed for sale. So these darker green lines show that all the sale activity absorbed the listings that were not sold in the previous month, as well as the new construction that have not been built yet, that had not even been listed for sale. So here we have that very strong market. And when the interest rates start crossing over 6%, we're seeing a little bit of that slowdown happening right here. Let's put those two graphs in perspective. See the blip here showing the beginning of the pandemic and a little bit of a slowdown, and then rates going down, sales of homes going up. And as the rates go back up, there's a little bit of a slowdown here with a dark green going downward. Let's take a look at what that means when it comes to days on market and the prices that they sell at. Well, days on market, it is an indicator on how fast the market is going. Now, in 2012, so soon as we were absorbing the rest of the 2008 financial crisis, the days on market were 60, 70 days, like just under 70 days. But what happened is we broke under 30 right at the beginning of 2020, and it kept going down to break under 10 days actually in 2021. So it was a very, very fast-paced market. And when it's very fast-paced, that means you have multiple offers, and that means you have sold prices, the difference between the sell price and the list price being over 100%. So the sell price being over the list price. see how it was before. It was pretty close, but a tad under. And here, this is where we see that the low interest rates combined with the low supply, combined with a strong demand, generated prices that were higher than the list price. Hence that strong appreciation that we saw in 2021 of 15%, right? Here is another view of it. When the inventory of homes is low, the median price tends to increase. And when the inventory of homes for sale increases, then the median price tends to stabilize and starts going down a little bit. Now, it doesn't go down to the previous level, but it decelerates, I should say. And this is what we're seeing in this market. Now that we have exited this abnormal pandemic-driven market, we are starting to see some price adjustments. There have always been price adjustments, but we are seeing a bit more of them. This is a little bit of a dated chart, but that's the most recent I have found. So we are seeing those price appreciation, those prices decelerating. So that's what happened. It's still interestingly enough, it's still a good market. It is what we have experienced was not a standard normal market. It needed to cool off, and that's what we're seeing today. So let me know if you have any questions about those slides, but this was a look back to kind of see what we had seen, what we have experienced, because there's a lot of information out there and it doesn't always make sense. Thank you so much. Bye.